Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
Welcome to The Wealth Flow. My guest today is Omar Khan. Omar has advised on $3.7 billion in capital finance and M&A transactions, as well as securing $130 million plus equity from private and institutional capital. He has graduated from Rotman School of Business, University of Toronto, and a CFA charter holder with 10 plus years of investing experience across real estate and commodities. As a principal of Boardwalk Wealth, Omar is primarily responsible for developing strong relationships with private and institutional investors, brokers, and strategic partners. He has closed over $720 million of assets across Texas, Georgia, Florida, and South Dakota. Omar, looking forward to this. Welcome to The Wealth Flow.
Well, thank you for hosting me, Keith. It's very kind of you.
I appreciate it. I'd love to start with your background. I know we gave a little bit of a snapshot of it there, but where did you grow up and what eventually led you to this world of investing?
So look, I was born in Dubai. I lived in Pakistan for the most part growing up. And then I went to college in Canada, Toronto, worked in Toronto and Calgary, oil patch, Canada, all like portfolio management, financial services. I've always been in the financial services, investment type industry. And, my family is an entrepreneurial family, reasonably financially sophisticated. So I guess, it's like, my wife's a physician, so now we get to meet a lot more physicians. I've got a lot of physicians in my family as well. So it's like how, engineers' kids oftentimes become engineers, physician kids become physicians, or entrepreneurial people, maybe they become entrepreneurial, right? So I wouldn't say there was like this one pivotal moment in my life which contributed to this. But, you grow up in an environment, oftentimes we don't even realize we're picking up things subconsciously. So I think the fact that I was in finance, I was very lucky. I had great parents, very supportive parents, great schools I went to all my life, great work experiences I had, mostly great people. Some were a little off that I worked with. But I think a lot of that stuff, I always find it interesting when people say, they had a seminal moment and that what contributed to their, whatever career or paths they'd chosen in their lives. I see a lot of that with pilots, with physicians, with teachers, those sort of people. But for me, a lot of it just seemed like a natural progress, basically, of the environment maybe that I was in, or the natural progress of my personal and academic and professional career of sorts.
Okay.
There wasn't one seminal moment. I wish I could tell you that, but I can tell you that nothing that I have done, because I moved to the US in 2015 from Canada, nothing that I have done while I'm here now in the US, I couldn't have even done a 10% of that if I was in Canada. Canada is an awesome, beautiful country. We always go back. We love it there. But the sheer fact that America is so entrepreneurial, people want to do business. They are encouraging of doing business. And the environment, I try to explain this to a lot of my friends, especially Canadian friends, or especially people that don't even live in Texas. You live in Texas, right?
Right.
Yeah, right. I try to explain it to a lot of my friends. I'm like, y'all don't really understand that there isn't like one thing. You're in this environment. People are very entrepreneurial, especially Texas. And you just think it's a reflection of how everyone else is. But that's not really the case because you go to a lot of other places and the culture is just so much different.
Yeah, for sure. Now, do you live in Texas? Where do you live in the
I live
U.S.?
in Dallas.
In Dallas. Okay,
Yeah.
cool, cool. All right. So both
You're
dialing
in
in
San
here.
Antonio, right?
I am
Yeah.
correct.
Home of George Strait, basically.
That's right. Hey, there you go. Exactly. Um, and so tell me a little bit about so this world of for maybe the audience and for myself as well. You're doing capital finance, M&A transactions. What all does that entail? Kind of
So
back the
on the
bell a little bit
financial
on it.
side, I worked in sell side, which is advisory investment banking, and buy side, which is the client side, where you are the company or the fund is actually investing their own funds. So capital financing, basically the transactions we did there were basically debt and equity related issuances. The reason is oftentimes you're issuing debt or equity. At that time, we could get a really good rate. This is around like 10-ish years ago, the rates were really low. So it was a very accretive way of raising money, but at a very cheap cost. Because think about it this way, if your business is, say, let's assume your business internally is generating 15% return on equity, but you can finance that, and this is during the time when rates were really low, you can finance that with, say, a 3 or 4 or 5% debt. Well, you would take that deal all day, every day, right?
Right.
Because you can get 15, you're already getting 15, you can finance and only pay 5 or 6, maybe. That's a deal you take all day, every day. So there are a lot of that. Equity issuance as well. At that time, I was working in oil and gas in the oil sands up in Canada. So they were a big couple of projects, Foster Creek, Christina, like there's huge oil sands projects. I mean, you don't really realize the scope of these projects till you actually go up there. So to finance those projects or the continuation of those projects, we did a lot of debt and equity issuances there. And M&A is just M&A. Basically, you're acquiring, you're disposing, merging, acquiring. I mean, that's it. That's part and parcel of any big company. And in a way, that's sort of what we do, less mergers, but more acquisitions, basically. And now in the current iteration of what I do.
Okay. And what type of acquisitions is your company doing now?
So it's all multifamily apartments. We do acquisitions, we do developments, we do management and in-house as well. So there's many ways that you can basically skin the cat, because a lot of folks, syndicators especially, I see they're just doing acquisitions because it's lower barriers to entry. But oftentimes the market, there's a flavor and season for each segment of the market. Sometimes acquisitions are great, sometimes developments are great. So for us, we want to be a full stack company. We've got a great management platform, very in-depth, world-class management platform. We partner with institutions, or other institutions partner with us, because one of the things a lot of folks don't realize is when you're hearing a lot of these headline institutions that raise billions of dollars in capital, they are allocators. They're not actually operators. So some big funds somewhere, California, New York, Miami, Chicago, Dallas even, San Antonio, might go raise a couple $100 million, a few $1 billion. Well, they're not typically in the business of the day-to-day operations of the assets, because they're in the business of raising money and deploying that money. It's not an easy task by any stretch of the imagination. So we partner with institutions as well. They bring us on to do their management and all of that sort of stuff as well.
Okay. And so you have your own property management then in-house?
Yeah,
or
I used to have it, basically. I kind of now just partner with one property management firm. We have a strategic ownership stake in them, and we just work with them basically now.
Okay. And according to your bio, you're focused on Texas, Georgia, Florida, South Dakota. Tell me a little bit about that. What do you like about those states?
Well, they're landlord-friendly states. I don't want to sound very political and talk about the other stuff. And after having lived in Toronto, great city, love it. I mean, my alma mater is there. The thing that I never really understood is it boils down to a very core fundamental belief. I'm of the opinion that if I provide a service, a job, or whatever, any type of service, and if I provided that at the right quality, that I expect to get paid for that quality of service that I provided. I do not think this is literally the foundation of how any economy, even a barter-related economy, works. Well, frankly, in certain jurisdictions in the country, the outlook and opinion is that you can provide a service, but people don't have to pay for it.
Yeah.
And that's a mentality I do not understand. And nobody can tell me it's a cultural issue because I'm an immigrant. I moved here. This country is based on the rule of law and the respect for property rights. And frankly, I do not understand the concept that if somebody is providing a service that one has pre-agreed to for the price they've agreed to, then you can't just be like, well, I don't really feel like it. I don't feel
Yeah.
like paying you. Like, I mean, I have 2 kids. I tell them most of the things we do in our life, we don't have to feel like doing them, but we have responsibilities and we have to fulfill those responsibilities. So that's why I'm in these markets, the states that you mentioned, because there is a clear rule of law. There is a balance between landlord and resident rights, because you need to have a balance. If you're just one swing or the other, like if it's all landlord friendly or if it's all resident friendly, I don't think that's appropriate. There has to be a balance. We have to be
Right.
respectful. This is housing, but these are states so far that believe in property rights, rule of law, and we just want to be in these markets.
Yeah. Makes sense. And did you see that in any of, had you all invested in other states before, or did you just see it?
No, Keith, look. I don't need to get punched in the face to know it hurts. Okay? I can tell you this, that having lived in Toronto, knowing lots of friends in Toronto, that families own lots of real estate, lots of friends in New York, Boston, San Francisco area, and hearing of their travails, which are like, you got to do cash for keys, as an example. You got to pay somebody for the privilege of somebody owes you money, as an example. They haven't paid you rent for a year. You have to pay them an additional amount of money and you have to also say thank you, by the way, along the way, for the privilege of them leaving and not paying you the money they owe you, and then also cursing you out on the way out.
Right.
Yeah, I don't really understand this. Obviously, this is a culture that I don't get, and I don't want to be a part of this culture.
Yeah.
So I don't need to go into areas. I don't need to look for fights. I just want to provide a good service. I want to get paid a fair remuneration for my services, and that's it, man. We don't got to be best friends.
Right. Makes sense. Yeah, it's crazy to hear some of the stories, not just in Canada, but in a lot of the blue states here
No.
during COVID.
This mentality is pervasive, basically. Have you ever heard of what's going on the coasts? Landlords are tearing their hair out. LA is basically, you literally, as an institutional investors have blackballed LA, most of them, as an example, and San Francisco as an investment city. Think about it. One of the greatest American cities, one of the richest cities in the world, right? And institutional investors are not investing in that city. Think about that. That makes no sense at all.
Yeah, that's crazy. Well, tell me a little bit about what type of projects you're buying, and then also, I'd love to hear what it is that you're developing as well.
Cool. So we have 3 verticals, right, in our business. One is development, one is value add acquisition, and the third vertical is an opportunistic bucket. The opportunistic bucket, I'll start with the opportunistic bucket first. In the opportunistic bucket, in the last 6 to maybe 8 months, we've acquired close to 1,500 units. This is basically because we have a great management platform. So lenders and borrowers alike right now are partnering with us because we can basically operate assets. Because for the longest time in our vertical, it didn't pay to have good management. All you would do is show up, hire a bunch of marketing people, raise a bunch of money, and try to flip assets. And even if you didn't perform, you would make money. Well, when the cost of interest rates started going up, those things have gone out of style. You can't just show up and be expected to make money for not doing anything. So there's a lot of stress in our industry, similar to other verticals, right? Private equity's got a lot of stress. VC's got a lot of stress. So it's the era of operators like us. So lots of people have upside down capital stacks, and we come in and we right size them. We take over management. We take over ownership of the assets. And the thing for borrowers is that they're taken off the guarantee, and now professionals are managing them. For the lender, you have to realize, a lot of people don't realize, the lender is your biggest partner in a deal.
Yeah, for
the
sure.
The lender now has a professional management company that is taking care of their collateral, so it's not becoming impaired. So we're really rapidly acquiring a lot of assets there. On the value add side, this was typically our bread and butter till about 2021, 2022. That's typically the little story, right? Deferred maintenance, partnership issues, somebody's at the end of their fund life cycle. If you can get a good deal, you buy it, right? It's lipstick on a pig type stuff. We've done about 2,000-3,000 units there. And then on the development side, this is all in the upper Midwest. We were selling our acquisitions, 2019 all the way to 2022. 70s, 80s, 90s vintage properties. I mean, they were nice properties, but they weren't like the greatest properties on the planet, right? And we were selling these for basically around replacement value. And as much as I'd like to think that I'm God's gift to management, which I'm not,
Right.
by the way, I'm not, in full disclosure, nobody's that good because the market was just hard. So we were selling these assets to folks at prices, frankly, that we would never even be buying these assets at. And then we started developing. I've got two great partners. Shout out to Dustin and Caleb, very experienced developers. And they needed a management platform. They plugged in with us. Now, as a team, they are excellent partners. We develop up in the upper Midwest. We've done about close to $150, $200 million of developments there. We've got a really cool model there that we've done about 10 times. And that's a model that works in the high interest rate environment. So all in all, we've done about $765 million in multifamily transactions, close to 4,000 units. And hopefully this is just the beginning.
Yeah. That's awesome. No, that's three good buckets there. Tell me a little more about the opportunistic. You mentioned kind of upside down capital stacks and then working with these. Are these owners that are reaching out saying, hey, we're in trouble here, or are you finding out about these because they're in receivership, or working with the lenders because there's an issue there, or how are you, in other words, how are you finding out about these, the opportunistic ones?
It's a combination of factors.
Okay.
I would love to say this is this one area and this is how you go do it. But it's a combination of factors. The combination of factors, number one, is a lot of borrowers that are in trouble will approach us because they know we have a management plan. I mean, a lot of these are my peers, by the way. And I don't want to throw shade at people because the problem is, look, there are lots of very good, thoughtful, very in-depth sponsors that unfortunately did deals at the wrong time. This, by the way, can happen to anyone. Okay? So I don't want to come across as sanctimonious here. That aside, there's lots of people that have no business being in this business.
Okay.
They were basically glorified marketing people, and there's nothing wrong with it, nothing wrong with marketing, because without marketing, no business in the world can run. But like I tell people, you can't just have a business which is all leaders and no followers.
Yeah.
Right? So borrowers come because we've gone full cycle with most of the major lenders nationwide. A lot of the contacts are coming through them as well. Or they'd rather be like, hey, why don't you guys connect? Or, hey, I have this in receivership. So it's a combination of about to go into receivership, in receivership, coming out of receivership, borrowers, lenders, property managers, lawyers, accountants, they're all feed. And by the way, a lot of times the investors are feeding us these deals. But, hey, I am invested in these deals. Here's this problem. Can you guys help us out? So I'd love to say there's like this one easy way of doing it because then my life would be really easy. But that's not the way. But look, along the way, I just want to point out, none of this is possible if you don't have a good management platform, if you haven't developed people internally, right? And that's an ever-evolving process. We're not 100% at it. We're always going to try to improve on it. And it's not possible if you don't have good, thoughtful partners alongside you. Because no man is an island, no woman is an island. We need to have thoughtful, capable, competent people alongside us.
Right. No, for sure. And I want to go to the management platform and kind of what distinguishes that. But before we do that, you mentioned on the development side that you guys have kind of followed a certain, I forget how you phrased it, but you based a certain model. Yeah. Tell me a little bit about that model. What about that model do you like? And, I guess describe it a little bit as to what you're doing.
I'll give you an example. Basically, here's the deal. It doesn't matter whether you're in the upper Midwest, you're in New York, you're in Dallas, you're in San Antonio, you're in California. Typically, if you're going to a new build suburban style building, right? Suburban apartment building, you're going to see a 2, 3, maybe 5-story. If it's 5-story, I think above 3 or 4 stories, you have to have an elevator, right? You're going to see this product. They all look the same, whether they're in San Antonio or Dallas or Atlanta or Tampa or whatever, right? They all look the same. And what you're seeing is when interest rates were close to 0%, a lot of the developers were just throwing everything in the kitchen sink at it. You have 3 types of pools. You've got a golf simulator, or dog wash station, or dog park, what is there is the electrical charging stations and a massage room and a yoga bar and a juice bar and this bar and that bar. And here's the problem. You can do all of these things when money is close to 0% because you can just keep throwing things against a wall. The problem now is money isn't 0%. Money's, if you're construction, it's like 8 to 10% on a senior loan. So now each incremental dollar you spend, you really have to be very careful in, well, why are you spending that dollar? Because you're probably not going to get an ROI out of it. And the problem with bigger developers is that like any big organization. I mean, look, the latest example is our government, basically what's going on, right?
That's right.
Like any big organization, there is bureaucracy and inertia. So a lot of the bigger developers, a lot of old timers especially, they haven't shifted with the times. They're still trying to build a product they should have built 10 years ago in a completely different interest rate environment to today. And like 3-4 years ago, again, we didn't know, obviously, that where rates were going to go, but we were looking at our projects and we were looking, hey, frankly, everybody says they want a pool. Everybody says they want a yoga bar, but not everybody wants to pay the price of a pool and a yoga bar, right? And what we're really concerned is not what you want, because if you ask me what I want, man, I want a private jet and a Rolls Royce everywhere I go. Am I willing to pay for it? No, because I'm poor. I ain't going to pay for that stuff, right? So the question a lot of times people ask is, hey, would you like this stuff? And the real question you should be asking is, are you willing to pay for this stuff? Because we are in the dollar and cents business. We're not in the dreams business, right? Yeah. Would I like this stuff? Yeah. Why? What luxury in the world would I not like? I like all the luxuries in the world. I'm just not willing to pay for most of them. So we started asking the question, what is the customer willing to pay for? What is a resident willing to pay for? And very quickly, what we realized is the resident is willing to pay for a great, well-designed apartment unit, Class A++. They are not necessarily willing to pay for swimming pools, yoga bars, all of this other stuff. They would like it, but they're not really willing to pay for it. And those features and amenities, when you add them, they add anything to 25 to 40% to your development costs because they're pretty expensive. So what we've decided to do is just focus on core amenities. We provide excellent products. The interiors are Class A++. Credit to my partner, Dustin and Caleb. Excellent job over there. And what we do is we put them in high traffic areas. So these look like boutique buildings. They're not. They're big 150, 200 unit apartment complexes. They look very boutique. We put them into the right areas. So, and then we partner with local people, as an example, gyms, coffee shops, all of that, to provide that service to our residents. What this has done is our hard cost of construction is about $140,000 a unit, between $135,000 to $140,000 a unit. You compare that with a typical developer that's building a wrap or a podium style building, and today their hard costs of construction are anywhere from $180,000 to $200,000 a unit. This means that if their costs, that's just hard cost. Then you add land, then you add soft, then you add fees. So the problem is, all in, you're looking at just construction-wise, $220,000, $230,000, maybe $250,000 a unit. Well, your problem is for a developer to pencil the project, they have to charge higher rents. And the issue there is the customer, after a decade or 15 plus years of rents going up like crazy everywhere in the country, by the way, not just Texas or California, everywhere, the customer is tapped out. The customer has no money. Inflation is killing the customer. So we are providing housing solution for the missing middle. It's like affordable housing without any of these government grants or any of this stuff, because the problem here is if you take government grants, then you gotta basically do their bidding. And nothing wrong with it if you know what you're signing up for, but typically when you take a government grant, you gotta basically create a dumpster fire. You're creating a dumpster fire for your buildings. And we're not in the business of creating dumpster fires. So we iterated this concept over multiple years, and now we've got a very highly efficient project that we've done 10 times, about $200 million worth of transactions, and we're just rolling these out.
Yeah. Are you, so on these buildings, are they, do you have retail at the bottom that you're working with these other partners?
Nope. Again, here's the deal, man. We did all this math. You start you cannot have project scope creep, basically. You can't have scope creep because here's the problem. Everybody starts by saying, I want to build efficiently. But what if I just add this one retail? What if I add just one pool? And invariably what starts happening, if one retail becomes 2, one pool becomes 2, now your costs start going up. We are maniacally focused on driving down our costs, but providing a quality place in a high traffic area.
Right,
And this is
right.
why we are delivering first units, by the way, the first set of units, 8 to 10 months. We deliver the entire project in 14 to 15 months, and we've got 90 to 95% occupancy between months 15 and 18. No other
Huh.
developer can do that right now. Most other developers are lucky if they deliver the project by month 18. Typically, they say 18, they deliver by month 20, 22. So by the time they are delivering, we are already 95% occupied.
Wow. Yeah. That's
Right?
great.
But again, if you're looking for a pool and you're looking for a this and a that, that's not us. But it turns out most of the residents out there, most of the people, by the way, upper middle class people, they have good incomes. They want to pay, but they
Mhm.
just don't want to pay $2,000 for a studio. They are more than happy to sign up for this.
Yeah. Yeah. That's great. Let's maybe talk a little bit about your kind of your management structure. You mentioned that a couple different times. Is there something specific that you guys are doing that you feel like distinguishes you within the marketplace?
I would like to tell you, like, there is some secret sauce, and I'm like a Wizard of Oz in the back, Keith. But
Yeah.
here's the problem: you are going to realize the bar is so low that just merely showing up, following up, diligently doing your job, recording and being organized, that already puts you ahead of 95% of people.
I agree. Yeah.
So I'll be honest with you. I wish I could tell you there's this secret sauce. I've got this one code, this AI piece of machinery that tells me I get up in the morning and tells me what to do. But we are extremely paranoid about every item. We are extremely diligent. We always think the world is going to end tomorrow, and we are extremely organized. Because like I tell investors alike, we can't guarantee an outcome, but we can guarantee you a process and professionalism with which we tackle these issues.
Yeah.
And we have very strong systems and processes in place. And again, it's an ever-evolving process, right? You can never get 100% on these things. Very strong systems and processes in place. We try to hire the top talent, and then we train them religiously. Because oftentimes what happens in companies is, I've been a victim of this. You hire somebody, they could be very talented. There is no onboarding. There is no training.
Mhm.
You just bring somebody and you throw them to the wolves. Be like, all right, go figure it out. And the person doesn't figure it out in the first week. And you're like, what, are you stupid? And you're like, no, you have to onboard me. I don't have the ability to read your brain. So we really focus on the front end of stuff, and we really focus on the processes. And that's why at the back end is just, the product of all the work you've done up ahead.
Mhm. Yeah.
Right? It's a bit like if you're an athlete, we're not, by the way, I can tell you, I'm not. If you're an athlete and you go to the Olympics, you don't go start doing the work when you go to the Olympics. Or the Olympics and your swim in the Olympics, as an example, is merely the end result of years of hard work that you've done to get to that point. It's not like you're going to the Olympics and you start working out twice as hard just to catch up for the days you missed.
Yeah.
It doesn't work like that. So it's every day showing up, diligently doing your job. And by the way, once you're done with all of this, praying to God that everything works out.
Yeah. For sure. What about are there so as you've grown the company, so I'm sure you didn't start with the structure that you have within that management company. So just
Oh.
curious, over the years, as you grew the company, as you decided to continue to add, what were some key hires that you made along the way? And, what were maybe some lessons learned as well?
Well, first of all, the lesson learned is don't be shy about paying for talent. Okay.
Okay.
We're all trying. I mean, I still have this issue. I think everybody has this issue. That the one thing I learned, but I have to keep, reiterating and repeating in my head. The one good thing about working in finance and tech, as an example, like good companies in tech and good companies in finance, they pay top talent obnoxiously well.
Right.
Okay, top talent is compensated. I mean, now, just for the record, they're not paying this because they're nice people. They're paying it because you have golden handcuffs, right? Then they work you like a dog. But you're also getting paid 2 to 3x what the next guy is getting paid outside of your company. So you're like, all right, dollars talk and bullshit walks, right? So one
Uh-huh.
thing really, and I still have to check myself. I still have to keep checking this. Top talent deserves top pay. Okay.
Yeah.
There's no other getting around it. All these companies and all these people will tell you, well, that's not always the case. And well, we've got a great culture. And you're like, man, no amount of culture is going to put food on the table for an employee. Okay. top talent deserves top pay. So you just got to find a way to pay. And one good person or one top talent is better than 20 mediocre people. That's just, I mean, it's by the way in every facet in life. It's not just our business, every business that I've at least seen. One top person is better than 20 mediocre people. 100% of the time. Top talent deserves top pay. And yes, I didn't start this way. It freaking sucks because I have literally done everything from scratch, right? From the bottom up, basically. I don't mean to sound like literally everything, but yeah, I created the asset management company and all of that stuff. But yeah, man, when I had money, I started spending it. And in terms of key hires, like our chief of staff, Eric, very diligent. Our director of asset management and operations, Miles, extremely diligent. Like you can train people, but at the end of the day, you can't teach people how to be consistent and diligent. That's something either they have or they don't have. Right? Yeah. So then being lucky to find these people who share a similar set of values, that's very important. So as much as I'd like to say, oh, I hired these people, I would also like to point out that a good contributor to my and their success was their own abilities and the fact that they worked hard. Because I could have done everything in the book. And if they weren't, it takes two to tango, right? If they're not ready to dance, there's nothing I can do about it.
For sure.
But I have to do my part, but I'd like to point out they did most of their part. That's why we're successful. That's why the team is successful, because the team showed up, basically.
Yeah. How often do your asset managers go out to visit the assets?
About once a month, and every week we have two or three check-ins with our property managers, one big meeting with our property manager every week, once a month at least, maybe 4 to 5 weeks. They're on site, they're looking at everything. Then we are getting real-time data from our leases, from our operations, and other aspects pretty much daily.
Okay.
It's a very laborious and intensive process. That's why you need quality people. Because errors can creep through or people can become lazy and then they don't do stuff and, then things go helter-skelter.
Yeah, for sure. What about some key metrics that you guys are constantly keeping in the forefront, measuring as you're looking at how are these, assets performing? Obviously, depending on the type, whether it falls in the development, the value add, or the opportunistic, there's going to be certain things on each of those, but in general, what are the things?
No, it varies by asset to asset. As an example, if an asset has basically a debt maturity coming up, that's an issue for a lot of folks these days. You are operating under you have to really go by your loan agreement to see, okay, what is allowed, what's not allowed. But at its very core, what are you managing? You're managing occupancy, you're managing the rental rate, and you're hopefully not getting gouged on your expenses. Now, all of this is good, but then we benchmark all of our assets against each other. Whether they're new, whether they're old, we benchmark them. We benchmark them from pretty much every single line item. But the biggest thing you're really looking for is, okay, what kind of revenue streams can I add? Because a lot of financial folks, but otherwise, generally, I feel people come in and they're very good at cutting costs because that's an instant sugar rush, right? Oh, I cut costs here. That's great. Well, number one, everybody can cut costs. It doesn't take a genius to cut costs. And the second thing is, the fact of the matter is you can't cut your way to prosperity. You can't save your way to prosperity. That shit doesn't work, right? So what a lot of people avoid doing because it's actually very hard and forces you to think is how do I raise the revenue? Like what steps can I take to add more revenue, add more lines of revenue, increase the organic revenue we have? We are very focused on that as well, apart from expense management. I feel a lot of people just focus on expense management and stop. And they kind of pay lip service to revenue, but they don't really do anything about it. And the constant benchmarking, the constant talking with each other, sharing learnings about each other, those are the real key factors that help us push our performance. But at its very core, the business is very simple in isolation. If you take out all the volatility, it's occupancy management, rental rate management, and then just running a lean shop, basically.
Yeah. Okay. And what as far as adding revenue, obviously right now, rents, as you mentioned earlier, we've gone on this run of just rents going up. What are you seeing right now as far as being able to push rents and maybe it's not just pushing the rents, maybe it's, we're putting covered parking or reserved parking or what are some other avenues of being able to find that?
I'm not a big fan of covered parking. I'll tell you why. Any item that requires me to go spend more money and then have like a 6 to 9 month wait before I start maturing out that revenue stream, I don't really understand that.
Yeah.
So I'm not saying it doesn't work, because look, if you're in a certain part of Texas where there's a lot of hail damage, yeah, shit, you got to do it. I get it. I'm
Yeah.
not like it's the same with washer and dryers. Everybody and their dog tells me you gotta put washer and dryers. I was like, no, you don't gotta do anything. Just go to Appliance Warehouse, have a deal with them. They will provide the machine, so they take on all the capex challenges, and you
Yeah.
are basically a middleman. You will charge your residents X amount, you will pay them Y amount, and you keep the spread. You have not had to generate any capex or any dollars out of your own pocket. You don't
Mhm.
have to take care of maintenance, and you are basically a toll collector. That's the best business in the world. You're not taking any risk and you're making money. Who doesn't want that, right? So for us, fee income, basically cable, Wi-Fi, reserve parking, any application fee, admin fees, pad fees. Shit, let me take this out. Hold on. Let me take out my benchmarking tool, and hopefully I can access it right now. The team isn't working on it, and I can tell you. Give me 1 second. What are just revenue streams? Again, this isn't rocket science. I can access it as hopefully as we speak. I don't want these to be famous last words. Uh, oh,
Yeah, I
jeez.
always love to just hear what everybody else is doing, to find those little extra things.
Yeah. Hold on. I gotta verify like 13 different things on our firewall before I access anything. Okay. Income wise, basically, not some of these you'll be like, yeah, duh, we do this already. Rubs. Hold on. Let me go down. Rubs, or rubs or trash, gas, water, electric, utility, pet rent, pet fee. Pet rent is different than a fee. Fee is one time, non-refundable. Pet rent and monthly. Community fee, technology fee, application fees, admin fees, security deposits, rental insurance, both revenue. There's a revenue and cost associated with it. Termination fee, short-term fees, on-site transfers fee. Then depending on if you're on the third floor or the fourth floor, there's a different viewing fee if you have a better view. Month-to-month fee, late fees, non-refundable utility processing fee, reserved parking, above-ground parking, covered parking, smart systems. Covered parking, we inherited a couple of assets that had this. Smart technology, storage, washer, dryer, rentals, cable, hospitality units, package concierge, water fees, processing fee, reserved parking, premium parking, and view fees. And then there's a whole bunch of view fees and ADA unit fees and all of that sort of stuff.
Cool. Yeah.
Yeah.
No, that's great.
Yeah, and
And
again, look, this is an ever-evolving process. A lot of times we're benchmarking, we see what we can do. And then if we're acquiring an asset or we talk to one of our peers and they're doing something, we share our knowledge with them and they share their knowledge with us, and we pick up a lot of education that way.
for sure. Yeah, that's one of the nice things about just being out there and talking to other people that are doing it. You learn a lot. I learn a lot just having these kind of conversations with folks as well.
Of course, yeah.
No one has a crystal ball, but I always like to get everybody's pulse on this. We're here we are, March of 2025, and we are kind of at the beginning of a new presidency. There's, a lot of uncertainty out there still. What do you see? What do you see in the next, 3-5 years ahead?
Well, what I see is basically that there's going to be a lot of issues happening. And I think it's going to become a little bit more worse before it becomes better. I think we're all, myself included, we're all relying on basically lower interest rates to help bail us out. But rates have to go down dramatically to bail people out, for the industry to atone for its sins in the past cycle. And the problem is, if rates are going down that dramatically, this possibly means that there is a recession that's already happening.
Yeah.
So, yeah, everybody wants rates to go down, but do you really want a recession? Because rates will go down, but the ability for your customer to pay you rent will dramatically decline. So you're in a no-win situation. So I think things are going to become a lot worse before they become better. Now, does that take a year, 2 years? The jury's out on that. But I can tell you, when we look at stats, there's a problem on the other side. With higher interest rates across the nation, what we are seeing is heading into the latter half of this year, especially Q4 of 2025, and then all of 2026, 2027, there's not a lot of supply hitting the market in terms of apartment units. And demand is still at an all-time high. Because, as you know, wherever you are in the country, buying a house is just next to impossible.
Right.
For the average customer. You need to be a multi-millionaire before you can start affording houses. The average American is tapped out of the housing market. So
Right.
where do they go? They go to apartments. Well, if the supply of apartments from Q4, this is a nationwide trend, by the way, heading into 2026 is significantly dwindling, well, then you're going to potentially have upward pressure on rental rates.
Yeah.
But the counterpoint to this is your rental rates might go up, but insurance and taxes are also going up very quickly. So your margin might be either stay at the same level or compress. Margin is basically the profit you're making. So the jury's out, basically, will the effects from potentially, if we do have lower interest rates, will they be more than the reduction in your margin? That's basically the big question. And I think it's going to take a few years. It's going to take 1, 2, or 3 years before we're able to conclusively come to any sort of idea. This idea that we're going to be out of the woods in the next year or two. Because look, 2 years ago, they said next year. Last year, they said next year. This year, they're saying another next year. I don't think it's going to be that easy to get out of these problems.
Yeah. Yeah. No, I agree with you. I think it's going to take a little bit of time. And I do think recession, that's the only way that there's going to be any meaningful, I think, correction. What does that look like? How bad does it get? Who knows? But, to get the correction I think we need, it's going to take something a little bit more dramatic.
And look, by the way, even without a correction, there's a lot of distress in the market right now. We just don't hear about it the same way because right now the distress is at the asset owner level.
Mm-hmm. Yeah.
But the real, the saying is, it's a recession when your brother-in-law loses a job. It's a depression when you lose a job.
Yes. Yeah.
Right. So right now it's a recession, and hopefully it doesn't become a depression.
That's right. Exactly. That's great. How about insurance rates? Have you seen any? I've been hearing from a few people that they're starting to see some of their rates come down a little bit. I'm not seeing that on any of my stuff.
Hold on. I think people confuse two items. One is the growth in rates, it's like inflation. The government's going to tell you, oh, we've got inflation under control. Prices are going to increase by 3% versus 5%. You're like, yeah, because they've already increased by 50%. Yeah. So I'm still getting shafted, right? Yeah. So a lot of times people confuse the actual rate of insurance with the growth in insurance. So last year, if let's assume, I'm making this up, if you had a 30% increase in your insurance rate, and now you only have a 2% increase in your insurance rate, people say, oh, my insurance went down. You're like, no, your insurance still went up. It just went up by a lower amount than it went up by last year.
Yeah.
But you're still paying the full load of that insurance from last year and this year. With us, what we've done is, because we have a lot of units, we've been able to move to a master policy. We've done some stuff, but at the end of the day, I don't necessarily think insurance rates have gone down materially in any sort of way. So I agree with what you're saying. The absolute insurance dollars that we're paying out, we've been able to manage that exposure, but it's still going up.
Okay. Does that make a big difference to move to a master policy? Is that a significant savings, or is it marginal savings, or what? What do you think?
It depends. How big is your master policy? What have you negotiated? Okay. Then, for instance, as an example, if you have a bunch of Class A assets, but you go onto somebody's master policy that has a bunch of Class D assets in crime-ridden areas, well, your rate might go up because now the nice assets are subsidizing the less nice assets.
Yeah.
Right.
Okay.
So there's a lot of variables. A lot of people use this fantasy of, hey, I'm going to a master. Great. There's more than a couple of variables here. Insurance companies didn't become this rich by offering simple solutions.
Right. True. No, for sure. This has been good. How can people find out, Omar, more about you? If they'd like to invest, if they'd like to just stay in tune with kind of what you guys have going on.
Well, look, you can join my mailing list by visiting my website, boardwalkwealth.com. The form is right on the homepage. Again, that's at boardwalkwealth.com.
Perfect. And I've got 2 more questions that I ask every guest. One would be, any advice you would give somebody who's maybe just starting out in their investment journey?
Make sure you've got rich relatives. That always helps, right? I unfortunately have some rich relatives. None of them gave me any money. So I should rephrase that. Have rich relatives that will give you a lot of money. How about that?
There you
That's my
go.
best
There you go.
advice to you. Or the other advice is, please, for the love of God, do not join any of these coaching academies, mentorship academies, any of this stuff. Please just keep your money. I swear to God, the people running these things are freaking idiots. They don't know their ass from their elbow. Okay, look. Think about it this way: you don't see, as an example, Donald Trump, our current president. You don't see him hawking coaching seminars at the airport Sheraton. Okay, there's a reason.
Right.
The guy's rich. He doesn't got to do this shit. Okay,
Right.
don't go to these coaching academies. Don't go to these mentorship groups. No matter what you think the online marketing is, if these guys were actually good at doing their job, they won't be in the coaching and whatever, this sort of business. Okay, this is just a business you got to learn. And look, you got to have some sort of background, either in financial services or your, I don't know, property management or construction or something. You can't be like, well, I'm a doctor and I'm just going to switch overnight. No, there's going to be a couple of steps, right?
Yeah.
So think about it this way. Whatever steps you had to take to achieve some level of excellence in your chosen profession, whatever that is, well, there's going to be certain steps you have to take along the way. Joining a coaching academy or any of these things, please, for the love of God, save your money. Okay?
Yeah. I think
Yeah.
that's really good advice. You hear the opposite a lot from a lot of folks as well.
Yeah, they're
And,
probably selling you coaching programs.
Right. There you go. There you
They
go.
tell you, hey, you should totally go do coach. It's like going to a barber and asking them, do I need to get a haircut?
Yeah. Yeah.
The barber's
Yeah.
going to say, yeah. The barber's going to be like, yeah, you need a haircut every day. Every day I need you to come and get a haircut from me.
That's right. How about a book recommendation? Doesn't have to be real estate related or
Oh,
finance
no, I can
related,
tell
but
you
certainly can be.
I just picked up tennis not too long ago, like 3 months ago. At
Mhm.
my advanced stage, I picked up tennis. And Brad Gilbert used to be this great American player, early 90s. But fact of the matter is, Brad Gilbert was never a good player in the sense that, he wasn't like supremely athletic and, some marvel of like physicality, right?
Yeah.
But Brad Gilbert found a way to stay in the top 10 for I think 6 years or something like obnoxious amount. He's coached, I think, Andy Roddick, and Pete Sampras, I think, and a whole bunch of other players, right? So the book's title is called Winning Ugly. And basically, I'm just reading this, rereading this now. I read this like 20 years ago. And the book, basically what he's trying to tell you in the book is you don't need to be the Michael Jordan or LeBron James of anything. And in this case, it's tennis, but I think you can apply this to anything.
Yeah.
What you just need to do a lot of times is, look, you have to show up prepared. You have to work hard. You have to think about what you're doing. You understand that there's steps you got to take. So for instance, you can't just, it's like you can't say, I don't want to do any of the exercise and the practice, but I want to win tennis matches. It doesn't really work like that, right?
Right.
There's a whole step and process in place. And he gives his own example. He's like, look, there's nothing special about me, because there was nothing. I mean, in fact, John McEnroe said when he lost to Brad Gilbert like a couple of times, this guy's so ugly, he shouldn't even be on the same court as me. But you understand the point he was making is you don't have to be John McEnroe. You just have to know the game you are playing and then diligently work hard at your craft.
Yeah. No, I love it. I have not had that recommendation, but seems like an awesome book. So I will put it down for my list.
Oh, he's the epitome of a guy who just 100% maximized his every God-given talent. He just literally extracted every last ounce out of that talent, basically.
Nice. Awesome. Well, this has been great, Omar, and I think we will call it a show. Thank you so much for being on the Wealth Club.
Thank you so much. I really appreciate it.
Yeah.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.